Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, as always, man, thanks for having me.
Crude oil has managed to hang in around the $50 mark much longer than people thought it would. And some are also hoping that maybe it'll hit 60 and continue to climb. Is that a false hope?
Well, let me answer the first part first. I agree. It held in longer than we thought. Back in June, we had what appeared to be the seasonal cycle top, which is an annual cycle, if you will. But then there's also a seasonality to crude oil that typically peaks around that time. So every indication was, yes, that was that annual cycle top. And then we moved down into the low in August, which we knew was an intermediate degree low and was going to be a retest of the seasonal cycle top that occurred in June. So that much we knew. What we didn't know, what we didn't expect, was for this retest to be as great as it was. So in that respect, yes, crude oil is definitely held in better than expected. As far as going now to higher prices, no, I don't see that in the cards. I think what we have seen is a retest of the June high. We had a short-term sell signal last week, and it's trying to evolve into an intermediate degree signal now. Hasn't quite done it, but once that cog flips, if you will, and we have that intermediate term signal, then we should have confirmation, and it will at least be set up to continue lower. And I think that's the direction it's going. I think that, like I said, long answer short, I think that this was just more of a retest of that seasonal cycle top than anticipated, and we should move lower.
Is there any underlying reason for it, or is it just the way the crude rolls at this time of year?
It wasn't. Well, it's the way crude rolls at this time. Like I said, seasonality, you normally get a low late or early in the year. In the winter months, you normally get a low, and then and it's not clockwork. But then the tendency is a better word to get the seasonal cycle top sometime around the driving season, June, July, August. And we got it this year in June. So the seasonality was right on cue. Like I said, the thing that was abnormal a little bit was to see, after getting that top, to see that much of a rebound and retest of the high coming out of that low, that intermediate degree low in August. That was unusual. And I don't know if, I can't explain that. I can just say that it was unusual.
Now, Tim, you predicted that oil would dip down into the 20s. It hit $27. What kind of a low do you see this time around?
That's a tough question. I don't have enough data, and I'm not trying to avoid the question. I think what we're going to should see is at least a retest of that February low. I don't know necessarily that it's going to violate it, but I think it's going to retest it. And what I need to see is whether or not it holds, because that's going to give me, how do I say this? The degree of cycle low that we're going into, that when I said the seasonal cycle top, we have that low coming up later this year in the winter months. Remember, probably, ideally sometime between, let's say, December and February. All right, so as we go back down, we're going to be making the same degree low that we made back in February. I need to see what the structure looks like as we get down into that low. I can just say this at this point. I think we're going to retest that level. I don't know necessarily that we're going to violate it. That's the test for the longer term. Do we have the longer term bottom? Not sure. I'm not sure, because my price objective was met, and now what I need to see is did that mark the bottom for the longer term decline? And I don't know the answer to that yet, but a retest I think is in the cards. Yes. So
we could be looking at the low 30s, high 20s?
I think so. I mean that's kind of my target. But then, if we get a decline into the seasonal cycle low, let's say, and it occurs at, I don't know, I'm just throwing a number out there, say the decline is less than expected. I mean, things do change and it can be more fluid than you anticipated. But let's say we only get a decline to 35. Okay, then so be it. Then that's going to tell us, then we're going to have structural evidence, and that's going to tell me, no, we've got a major bottom in place at that point, because the degree of the low that we're moving into, with it occurring and holding above the previous low of the same degree, is going to be structural confirmation that we've had a higher degree low. So again, I need to see that. I need to see the structure as we decline into that low. But I do think we've got the so-called seasonal/annual cycle top, and that we're going back down to retest that low and either probably make the final low or confirm that we've got the final low.
We'll have more with Tim Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's the outlook for gold? It's been a little soft after that drop about a month ago. What's the outlook now?
Well, we talked about the intermediate degree top in gold. I know it wasn't popular, and I know that the advance out of the low last, December, I think we made the low. I said that it was a counter trend advance, and that we identified the intermediate term top back in July, and I said that it was going to move lower. And, gold kind of flatlined and didn't look like it was going to go lower. It resisted, but the cycle finally came to pass, and it has broken into the intermediate degree low, which is due now. And I'm pulling up a chart as we speak. I think it was on October 7th. Yes, October 7th, we had a short-term cycle low, and gold is now trying to make that intermediate degree low. And it's kind of the same story, but on a different scale with crude oil. We are either at the intermediate degree low, or we're going to see it with one more push down, I think, in gold. But in the bigger picture, I think that it's going to be another counter trend advance. It should not ideally move above, the July high. It should just, be some sort of like I said, a failed rally. And then gold should continue lower into that 9-year cycle low. And the good news with that is, as I've said all along, that the big opportunity that everybody is looking for is coming out of that 9-year cycle low. And we're closing in on that. But I think there's still more downside ultimately before we get to that low. And the time frame for that should ideally be, looking at the cyclical phasing, it should be sometime in the late this year to early next year. I'm talking December-ish to maybe January, February-ish. We should have that, we should be in the window then for the 9-year cycle low. That's kind of the expectation.
Of course, people, if they bought gold now with that cycle in the long term, would still be okay, wouldn't they?
Yeah, I mean, we're talking the difference of a couple of $100, but I mean, I would, yeah, I mean, if someone can stand the pain of a 20% loss or 15% loss, if we were to see a violation of that December low, but I do expect to see that December low violated, ideally. And I say again, I'm saying that based on statistics. I mean, every 9-year cycle low since the, inception, since gold has been freely traded, there have been 9 of these annual cycles within gold, and each one has moved below the previous low on the way down into the 9-year cycle low. Well, the December low was cycle number 8. So we should, unless this time is different, and it's hard to bet on something being different this time statistically, but we should have one more push down. So if one is willing to take that risk, absolutely. But I do see the big move in gold coming after this next push down.
Now, of course, a lot of people like to buy gold as a hedge against fall in the stock markets. What's your prediction for equities?
Equities, man, they are hanging on a cliff. In 2007, everything went down together. Gold, oil, it didn't all top together. Oil, I think it topped, I don't remember. It's been too long now. I think it peaked in like August, I want to say, of 8. And we saw it peaked in 8. And then gold, it peaked, let me look at a chart. I don't want to misspeak. Its 9-year cycle peaked, yes, it also peaked in 8. It was early 8. But everything flushed out together into that low in 9, late 8 and 9. And that's the kind of thing that I've been expecting here. There's this thought that if equities go down, that gold automatically goes up. And that's not necessarily true. People they connect these false dots. If something happens once, they go, oh, that's a pattern. No, it's not. And so I keep looking for, and the expectation has been all along, that everything flushes together. And I still think that's probably what we're going to see. At least that's the expectation until it's proven differently. That said, for equities, God, you know the story, but I stand by the statistics. This is the most extended 4-year cycle ever since the inception of the averages. The statistics tell me, and it's almost hard to even say it at this point, but, we should see this thing collapse below the 09 low. And that is absolute insanity to even say, but that's what the statistics tell us. And the fact that it is extended as long as it has, the fact that it has been extended due to the manipulation like it has, the fact that the statistic still lies, the fact that when you look beneath the surface at some of the other indexes and averages, when you look at, you start comparing some of the internals with this intermediate term cycle to the last intermediate, there are all kinds of clues and warnings that no one is seeing now. I've never seen complacency so high. I've talked to other technicians who've said the same thing in their careers. Of course, that makes sense. I mean, we've never seen anything like this. I'm convinced that the manipulation that's going on is they're attacking, if you will, critical technical junctures to try to hold the market. It's insanity. But it's still a bubble, and it can't go on forever, and it is set up for that collapse. And I don't know, at one of these critical junctures, be it, now or the next time we get to a technical juncture with the right cyclical setup, which may occur, I don't know, I'm just throwing something out there, when we get there. Is it 2 weeks from now or a month from now or 6 months from now? One of these junctures, it's going to crack. And I don't think this market can take a 20% decline, let's say. I think a 20% decline would spook the cattle so bad that it would be a 70% decline. And something that we forget, a couple of things. When I look at the so-called the seasonal cycle, and you know, there's, like I said, the 4-year cycle that's averaged 48 months. Well, within the 4-year cycle, there's a little annual cycle. Call it a seasonal cycle. When you look at all those seasonal cycles, and I'm not looking at my spreadsheet. I have a spreadsheet with the math done. But when you look at all those seasonal cycles since 1896, that cycle from top to bottom, the ebb and flow of that cycle has averaged right at 20%. Do you know how long it's been since we've had a 20% decline? It's insanity. People have been put to sleep here. They don't, it's been so abnormal so long it seems normal. And I don't think just a normal decline into that a seasonal cycle low, I think it's going to result in the collapse or potential collapse in which we could see those statistics fulfilled where we go below the 09 low. I know it sounds crazy, but I stick to the numbers and the statistics until they have proven wrong, and they haven't been proven wrong yet. Another thing, let me say this. When I say they haven't been proven wrong yet, you say, well, I know a lot of people are looking and listening and saying, well, it hadn't happened. No, it hadn't happened, but it hasn't been negated. The setup hasn't been negated either. And one thing I want to remind people, if you look at this market, and I'm not counting it, but I want to say we're in the same position we were in about, I can't remember if it was 16 months ago. 16 months ago, I believe the industrials is at the same level, and I could be wrong on that by a month or two. I can't remember. It's been a couple of weeks since I counted that, but I want to say we're at levels 16 months ago. We've gone nowhere. And so while one may argue it hasn't cracked, true enough, but it hasn't gone anywhere either, and the setup is there. So therefore, the risk remains, and I think when it cracks, it's going to crack, and crack hard.
What about all these pension funds that have invested in the equity markets?
What about them? I think that there's going to be, I'm not sure what angle you're talking about, but I think there's going to be a lot of people hurt because of the complacency. I think that, and that's what makes this so bad. I think that, you know, like I was talking to a friend of mine, and he was talking about the teacher pensions and state retirements and that sort of thing that are heavily invested in the markets. And, you know, these people don't understand. They don't, I know it sounds like you keep crying wolf or fire or whatever in the auditorium, but it is what it is. And the point is that this is hung on and drug out so long that the people that are seeing it and screaming fire, you know, no one's listening. But it doesn't change. It hasn't changed the setup or the risk associated with this. It's just, I understand the complacency. That's what makes it all the more dangerous.
I was going to say the fire is smoldering under the floorboards and the wolves are hiding out in the pantry. They're there. You just don't see them.
Look, I know, I understand it's almost discrediting to even talk about that for some. I mean, they go, yeah, you've been saying it. Well, you know, here's the thing. Couple of things. Every setup is a little bit different. Looking back at 2000, identified the top in 2000 perfectly. I mean, we got the setup. The DNA markers fell in place. In print in a magazine. Boom. If you look at the market, though, it kind of flatlined for the remainder of 2000 and even into 2001. It really went nowhere. It was up and down and up and down and up and down. And then but it never took out the high, and then it cracked. And then went down into the 4-year cycle low. And the statistics said that it should go below the 98 low, and it did by 200 points. And then, coming out of the 02 low, the 4-year cycle extended and extended and extended, and at that time, it was the longest extended 4-year cycle in history. And as I kept saying, nope. It's going below. The statistics say it's going below the 02 low, and it finally set up. The DNA markers finally fell in place. That time we had a high. I don't know if you remember, but we had a high in July. We went down into August, and I said, nope, that's not it. We didn't have everything in place. We needed one more push. We got it into October. It set up, and that time it fell apart pretty quickly. You look back at like 87, it fell apart quickly. You look back at 29, it fell apart quickly. 66, it was a little slower. At 66 to 74 period was a little different. There was some lingering with some of the 4-year cycles in there. So every setup is different. You can't control that, and that's not an excuse. It's just a fact. And so while I make no excuses for the work, it is what it is. And the statistics, like I said, it stands, and I stand by it. But we are dealing with something we've never seen before in the degree of the effort to hold it. And like I said, in and of itself, every setup is a little different. So while we haven't cracked, we haven't negated it either. So there you have it.
Is Warren Buffett right to hold $75 billion in cash, waiting for this crash to happen so he can pick up the pieces and make a big profit?
Sounds to me like he knows what's coming.
Well, he wouldn't have that kind of money if he didn't.
Right. And look, for our listeners, I get it. I understand the complacency. I understand the reluctancy to believe the work. And I'm not talking about past calls to try to, tout a past call to cover up what's going on today. And no. I'm saying the same methods, the same statistics, the same stuff tells me, it gives me the what it gives me for the current environment. Calling the move to, for crude oil to move into the 20s when it was still in the $100 range was insanity. But it's just numbers and math and statistics. It worked. It happened. Saying that gold topped and there was a counter trend advance out of the December low and that we should move lower, which, it struggled with moving lower, but it has, and I still think there's more to come. But, that was kind of a hard call. Nobody wanted to believe that. Calling crude oil top back in 2008 and that it would go below the previous low like it did was insanity. It's just statistics. And odds are they're going to be fulfilled, but there is a little bit of gray as into how long and how soon you see that stuff come to fruition. The problem here is we have enormous manipulation, and that's not an excuse, it's a fact, trying to negate the natural forces. And my hat's off to those efforts because they've done one hell of a job. But in the process, it's only made an even bigger bubble.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood. You can check out his website at cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.